S corporation payroll and the highly debated topic of reasonable compensation. That's what we're going to be covering today. Hey guys, my name is Mike. I'm one of the partners at Ledgerly, where we specialize in all things tax strategy, tax advising, and also your general accounting partner when it comes to bookkeeping and accounting needs. Before we hop into this, make sure you bang that subscribe button. Follow us weekly for great tax tips, tax content, and we're also on Instagram, Facebook, all other social media platforms. So let's dive right into it. So S corporations, right? We're no longer a single member LLC. Now we're taxed as an S corporation. So now we're the business owner, and now we need to pay ourselves, right? How much are we supposed to pay ourselves? What's the right number? What's the wrong number? What's too much? What's too little? That's what we're going to be talking about today. So let's go right to the whiteboard. All right, so we're live at the whiteboard here. So let's walk through a little case study here. Let's say we got Joe. Okay, that's not Joe. There's Joe. And let's say Joe has a let's say he's got a landscaping company. So Joe Landscaping LLC. All right. Now let's say Joe's crushing it, right? And he just converted to an S corporation. Now, if you guys want some more great things on S corporations, we just did a podcast about 50 minutes going through all the great things of what it's like converting to an S corp, what it looks like, what are the tax benefits, all things S corps. But what we're going to be focusing on today is just the payroll piece with reasonable compensation. So let's say Joe's Landscaping LLC. There we go. That's an LLC. Let's say Joe is bringing in, he's bringing in 150,000 in gross revenue for the year, right? Okay. So that's his revenue. And let's say Joe's got 50,000 of expenses. All right. Joe's rocking. He's rolling. He's got net taxable income of $100,000. Now, what this 100,000 is all of his other expenses, like his vendors, his credit cards, all of that stuff, and also maybe his other employees that he's paying. This 100,000 doesn't include the money he's already taken out or his salary that he's taken out. Now, this is where the reasonable compensation piece comes into play. This is the highly debated topic. A lot of accountants, I don't want to be stereotypical, but I'm just going to say the older generation of accountants. The older generation of accountants would say, okay, well, you need to take reasonable compensation on this 100,000. And maybe that reasonable compensation is a 50-50 split. Let's say it's 50,000 of W-2 and 50,000 of K-1. Now with the K-1 that's the distribution. So now if we go back to our other podcasts, you guys tune into other things, we know that Joe is only going to pay the self-employment tax on this piece here. He avoids the self-employment tax on the K-1, on the distribution. Okay. But let's say Joe doesn't need $100,000 to live on. What we like to do, what we like to advise our clients is we take a step back. We undo all of this. We say, hey, Joe, as Jimi Hendrix said, hey, Joe. All right, maybe I got to work on my vocals. Hey, Joe, out of this 100,000, what do you need to live on? And now this brings up another topic, guys. Do a budget sheet. If you're married, you have kids, the whole 9 yards, do a budget. What do you need to live on? Maybe nowadays, $100,000 isn't a lot to live on with a family. But let's kind of take a step back here and let's assume that we said, hey, Joe, do a budget. Okay. Joe now only needs 70,000 to live on. Other 30K, he's still going to pay income tax on this, but it's going to remain in the business and it's going to be phantom income. So maybe he's leaving that for a rainy day for later. Maybe a nice piece of landscaping equipment here. Maybe he's got a nice steel lawnmower that he wants to get, or Milwaukee tools, or whatever it might be. That other 30 is going to remain in the business. It's called phantom income. He's still going to pay income tax on it, but it's not going to impact his payroll allocation. So we say, step one, Joe, what do you need to live? $70,000. Now we do the payroll allocation on the 70,000. The W-2 split, the K-1 distribution split. Now, this is where we get into the highly debated topic. For one, the highly debated topic was, do you do the payroll on net income or what you need to live? We say on what you need to live. Step two of the highly debated topic is, how much of the 70,000 is going to be payroll? How much of the 70,000 is going to have payroll taxes associated with it? Okay. That's where I'm in a tax network that there's this thing called the payroll matrix, and I'll draw it out for you. It's a line graph, and there's basically, rivets here, rivets here. And the horizontal graph is basically this number, the 70,000 number, right? So let's call 50K, 100K, 150K, meaning what do you need to live on? Or how much you're taking out of the business, whether it's W-2 or K1. And then this is the percentage of payroll, 25%, 50%, 75%. And what we're taught in this network is as the amount of money you take out goes up, the percentage of payroll goes down. Now, this is not drawn to scale. It's just a visual. But what I want to do is pinpoint this here. Let's say he's at the 70,000 mark here, 70K. On 70K, he's going to be on the side where more of it is going to be allocated to payroll. Okay. But let's say it's a 50-50 split. Okay. Let's say the 75,000 or the 70,000. He's going to do 50% payroll, 50% K1. So Joe, on this amount, he's going to have a 35,000 W-2. He's going to have 35,000 of distributions, and then an additional 30,000 from up here, because he's still going to pay income tax on it. He's going to have this amount. The 35 and the 30 is going to be his K1. So his K1 is going to be 65,000. So the 65 and the 35 gets us to the 100,000 up here. So this is a lot of information, but let's take a step back. All of you S corporation owners out there, there's a lot that goes into this. Because we don't want to, this is going to be a discussion for another time, but you don't want to take out more than what you put in, meaning you don't want your basis in your S corporation to go to zero. And the easiest way to explain that is you open up a bank account and you put $5,000 into the bank account. You're not going to take more than 5,000 out because then you're going to have an overdraft fee. That's the same thing with an S corporation. You don't want to take out more than what the worth of your S corporation is. Discussion for another time, but that's S corporation basis. The other caveat here too is, let's say you're a rock star. You know, you have no consumer debt. Maybe you have some business debt or some rental properties. That doesn't count. You have debt that's working for you. You have debt that's it's a passive activity. It's an asset for you. Let's say you're rocking and rolling, and you want to start putting a lot away in a 401k plan, and you want to open up a solo 401k. Now you're gonna have to take a larger payroll if you want to max out your 401k. Discussion for another time. But what we're getting at is reasonable comp. Okay, what the goal is to take out as little payroll as possible for the payroll tax side, but to also take out enough so you can live, so you can have a cost of living, so you can put food on the table. So when we kind of get into, you know, we make the S corporation conversion, the wheels start churning. What we do is we sit down with our clients and we say, number one, cost of living. I'm gonna do COLA, cost of living adjustment. Sit down with a budget, you and your wife, you and your spouse. Sorry for the chicken scratch here. Sit down with a budget. What do you need to live? Yeah, like what if your business is bringing in $1 million in profit, but you don't need $1 million to live on every year? What if you only need 100,000? So that's what we base this on. We say, okay, take your budget. What do you need to live on? Question mark, exclamation point. Nowadays it's a lot because everything's expensive. Set your budget. Mortgage, food, groceries, utilities, insurance, everything. We have a great budget sheet that we can also, you know, reach out to us and we'll send it. Okay. Number two, that's where we nail down the payroll, like that we did above. Nail down payroll, and we take a look at this matrix and we see where you fall on the matrix. And then based on the matrix, we do the allocation. Right? Joe made 100,000 in his business, but he only needed 70 to live on. That's what we base payroll on. So that's the moral of the story. Is that's kind of ground zero. From there, we go up from 401k. From there, that's when we start talking about, okay, what are the other options that we have? Let's say every year he's been putting away 30,000 as phantom income that's still in the business, whether he's reinvesting it back into the business, or maybe one year, hey, let's start up that solo 401k. Hey, let's get our spouse on payroll and let's start maxing out these solo 401ks for retirement. Yes, we're going to pay payroll tax because it goes as W-2 wages. But if we set it up the right way as Roth dollars, we're going to pay the tax now and never pay tax again. So it's a two-sided coin. That's what it comes down to. Over here, you can either have, it's like a quadrant, right? So it's, do we want to have less payroll tax equals less cash flow, right? We can have more payroll tax equals more cash flow. If we have less payroll tax and more cash flow, that might mean we're getting too aggressive, meaning that we're taking that 70,000 out, but we're only allocating like 10,000 to payroll. That's very aggressive. Okay. That's where we want to be careful. Or we can have more payroll tax and less cash flow. This is the area where the fringe benefits, the 401ks come into play, the solo 401ks, because you're putting more money into retirement that's on your W-2 and you're not seeing that come into your pocket. So when it's time to do that is really when you don't need excess, it's like free cash flow. You can, if you don't need those extra expenditures, if you can take this 30,000 up here, this 30, and dump it into the 401k, that's when we're ready to do that. It's really going to come down to these two here. Number one, in a easy situation, less payroll tax equals less cash flow. More payroll tax equals more cash flow. Because less payroll tax means that you're taking less out of the business for yourself to fund to live, your cost of living. If you're taking more out to fund your personal life, then it's more payroll tax, because then it increases the matrix here, right? So what we want to do is nail down that sweet spot. Once we nail down that sweet spot, then we can start talking about all the other benefits that come with an S corporation, okay? All right, take a big step back here. This is a lot of information. The moral of this is, as an S corporation owner, you need to pay yourself. You're no longer a pure W-2 job. Now you have that mix of W-2 and distribution. Don't be afraid to be too aggressive with this. We use this matrix. We're in a tax network that uses this matrix, and we teach this to our clients. So if there's any doubts, go to the website, email us, book a call, follow us on social medias. We're always posting shorts on Instagram. We have more of the long form content on YouTube. So please get in touch with us. We'd love to schedule a comprehensive consultation with you, because one of these strategies, this strategy that we went over, reasonable compensation, is one of the 25, 30 strategies that we cover with our clients. So the goal is to keep as much money in your pocket, keep it out of the government's pocket, and just keep building that business to the point where we can start funding those 401ks, maxing out the retirements, paying the kids. We're just scratching the surface here with the reasonable compensation. So again, like, comment, subscribe, follow us, and we're looking forward to working with you.